Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host, Daniel, bringing you the highlights and the happenings from around the world. Let's dive into the numbers and stories that moved the markets last week. Equity markets experienced a significant correction last week, except mixed Chinese equities. Major U.S. benchmarks closed lower, influenced by earnings reports and key economic data. The S&P lost more than 2%, the Nasdaq lost 3.3%, U.S. small-cap indices lost more than 6%. The Nasdaq Composite entered a technical correction, falling over 10% from its July high. The Pan-European StoxX Europe 600 index fell by 2.9%, due to concerns sparked by weak U.S. economic data. Major European indexes, including Germany, France, and Italy, experienced notable declines. The UK's FTSE 100 also fell, but to a lesser extent. Japan's stock markets faced heavy losses due to a hawkish shift from the BOJ, with the Nikkei 225 falling 4.7% and the Topix index down 6%. The Nikkei's one-day plunge on Friday was among the largest in its history, similar to declines seen during major global financial crises. Chinese equities experienced mixed results amid weak manufacturing data. The Shanghai Composite Index rose by 0.5%, but the CSI 300 fell by 0.7%, and the Hang Seng Index in Hong Kong declined by 0.4%. The yen strengthened to 148.9 against the US dollar, affecting the earnings outlook for export-oriented companies. The pound finished the week higher versus the USD. The euro also strengthened slightly. Oil price continued to fall due to demand concerns. Gold futures achieved a record high, briefly exceeding 2,500 USD per ounce on Friday amid economic uncertainties and investor demand for safe haven assets. The job report of only 114,000 new jobs in July, well below expectations, alongside a higher unemployment rate of 4.3%, signaled a more rapid cooling of the labor market than anticipated. Additionally, significant capital expenditures by major tech companies, particularly for AI development, have also impacted investor sentiment. The ISM Manufacturing Index fell to 46.6, marking continuous contraction. The Federal Reserve's stance on interest rates remains cautious, with potential cuts on the horizon if inflation eases further. Government bond yields fell sharply, with significant drops in 2- and 30-year note yields driven by economic data and shifting rate outlooks. In response to economic conditions, the Bank of England, BOE, cut its interest rate for the first time since March 2020. However, the BOE's cautious stance on further rate cuts was highlighted by Governor Andrew Bailey. Meanwhile, German bond yields fell in anticipation of potential rate cuts from the European Central Bank. Inflation in the Eurozone slightly increased in July, and the region's economy grew faster than expected in the second quarter, despite Germany's contraction. The unemployment rate in the Eurozone rose slightly, but consumer confidence improved. The BOJ raised its key short-term interest rate to around 0.25% and outlined plans to taper bond purchases, reducing monthly purchases of Japanese government bonds, JGBs, to about $3 trillion by the first quarter of 2026. The BOJ also revised its core inflation and growth outlooks down for fiscal year 2024. Manufacturing activity continued to contract, as evidenced by the official PMI and the Caixin Manufacturing PMI, both indicating declines in production and new orders. Despite these challenges, industrial profits increased in June, driven by a recovery in top-line revenue and industrial production growth. However, the overall economic outlook remains cautious, with persistent weaknesses in domestic demand and expectations for continued government measures to support the economy. What to watch this week? Last week saw volatility due to weaker U.S. data, a dovish Fed, and a hawkish Bank of Japan. The key U.S. event this week is the ISM Services Report, with mostly secondary data from other regions. Geopolitical developments could induce caution, but recent corrections might revive risk appetite. Here is what to keep an eye on. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.